Most traders believe that winning means being right, more winning trades, fewer losing trades, higher accuracy. It feels logical, it feels comforting, it feels measurable. But in trading, being right means almost nothing. What matters is expectancy. Expectancy is the average amount you make or lose per trade over a large series of trades. It is not about how often you win. It is about how much you make when you win versus how much you lose when you lose. A trader can be right 70% of the time and still lose money. Another trader can be right only 40% of the time and grow capital steadily for years. Because expectancy measures performance over time, not emotional satisfaction in the moment. Old school traders understood this instinctively. They did not brag about win rates. They talked about risk, reward, and survival. They talked about staying in the game long enough for small edges to compound. They knew the market does not reward accuracy. It rewards discipline applied consistently. This is where many traders become trapped. They chase high win rates. They avoid taking losses. They cut winners too early. They hold losers too long. They want to feel right, not operate profitably. This creates a dangerous psychological loop. A trader becomes emotionally attached to winning. They begin avoiding necessary losses. They hesitate when trades go against them. They start moving stops. They interfere with exits. Ironically, this behavior lowers expectancy over time. The desire to be right slowly destroys profitability. Expectancy requires emotional maturity. It requires accepting frequent losses. It requires allowing winners the space to develop. It requires consistency, even when short-term results fluctuate. This feels deeply uncomfortable to the human mind. Humans evolved to seek certainty. We crave immediate feedback and validation. We avoid discomfort and ambiguity. But markets reward the opposite. They reward patience. They reward discipline. They reward tolerance for uncertainty. They reward consistency over time. Expectancy also teaches something humbling. No single trade matters. One trade cannot prove intelligence. One trade cannot validate a strategy. One trade cannot predict the future. Only series matter. Expectancy only reveals itself across large samples. This is why professional traders obsess over statistics. Average win size, average loss size, risk per trade, drawdowns, expectancy per 100 trades, variance, not because numbers feel comforting, but because they replace emotion with structure. Numbers allow traders to separate signal from noise. They prevent emotional overreaction. They create stability during inevitable drawdowns. A trader with positive expectancy does not panic during losing streaks. They anticipated them. They do not increase risk after winning streaks. They understand variance cuts both ways. They do not abandon systems prematurely. They respect sample size. They operate with calm patience. Expectancy changes how traders experience time. Short-term boredom becomes irrelevant. Short-term frustration loses power. The urge to constantly trade fades. You begin operating instead of reacting. This also changes identity. You stop measuring yourself by daily results. You stop tying confidence to recent outcomes. You stop chasing emotional validation from markets. You begin thinking like a business owner. Capital becomes inventory. Trades become transactions. Risk becomes cost of operation. Expectancy also protects traders from self-sabotage. It prevents revenge trading. It prevents emotional overconfidence. It prevents impulsive decision-making. It anchors behavior to process rather than emotion. This is why many traders struggle to adopt expectancy thinking. It removes drama. It removes excitement. It removes ego reinforcement. It feels boring, it feels slow, it feels unglamorous, but boring compounds. Excitement often destroys capital. The traders who survive decades are rarely the loudest or most dramatic. They are consistent. They are patient. They are emotionally neutral. They respect mathematics. Expectancy turns trading into a long-term craft, not a game of prediction. It removes the illusion of control. It replaces hope with probability. It replaces fear with structure. You stop needing to win today. You start needing to execute well consistently. Over time, edges express themselves naturally, quietly, predictably, relentlessly. That is the power of expectancy, not excitement, not brilliance, not prediction. Just disciplined consistency applied over time. And over time, time itself becomes your advantage. Because in markets, the trader who survives longest is the trader who compounds most. And expectancy is what allows compounding to happen.